Ladies and gentlemen, welcome back to the channel. Futures are clapped, but we are in there like swimwear, ready to get this show on the road, ready to make some money. We're going to speak it into existence. But, we'll see what we're dealing with. Futures are down, NASDAQ, everything, Dow, S&P, all of it, down 0.77%. What's up, Jennifer Hendricks? Ugan, Super Show, Big Blue CNC, baby, in the building. What is going on? Lots of red in the futures. Everything is down, almost matched up perfectly, and oil is down 2.6%, so not so good. And the bond yields are down, which is kind of incredible that all of this looks to be down. So we'll see. Tickle the like pickle. I agree with Super Show, baby. Tickle the like pickle. Don't short the like button. Statistically speaking, I heard that it makes you more money by hitting the like button, and that is free 99. But that's just a rumor. What's up, Tyler? Let's go, baby. Cheese Chaser in the building. Showing up. Ready to go. Me too. Oh, yeah, baby. Popcorn, apes, and popcorn. We love popcorn. What's up, Tyler and crew? Let's get it. Bill A, 87. Moon. Let's go. The pollen messed me up, guys. I live in Michigan, and yesterday was like 80 some degrees. The day before that was like 40 something, and today was like 79ish, and then tomorrow's gonna be like 40s again. So the pollen has clapped me, and I was out raking, doing some yard work, my shirt off, impressing the ladies and whatnot, and it just pollen clapped me. Will be nice when the saga ends. The ride has been wild. Oh yeah. And I say it all the time, but I want to fully clarify this, and I don't know how to fully clarify this. Like, other creators really have not caught on to this. It's what I've been saying the whole time. You need liquidity to dry up in order to see a short squeeze in the magnitude that we are looking for. Yes, you can see small short squeezes here and there, but bottom line, push comes to shove, stocks go up, stocks come back down. What is the only thing that keeps a hedge fund in the game, that keeps them in a short position until ultimately the stock comes back down and they can cover for a small loss or even at a profit still? It's liquidity, it's capital, it's these investments that can be used as collateral, like bonds, right? Treasuries. Who the hell in the world would not take treasuries as collateral? Well, those have got clapped. Stocks, same thing, heading down. Who wouldn't take Apple as collateral for a short position? So when these assets come down and when interest rates go up, it really starts to put pressure on these short sellers if and when a catalyst comes for AMC stock. Now, this won't trigger a short squeeze just because these assets are going down. Bonds, stocks, that won't cause it. But when you see a catalyst that can drive AMC stock up, that's when you will see the basically the flood to cover on short positions. Because imagine in your portfolio right now, no matter what size it is, let's say you got a bunch of margin, like we know Citadel is like 10 times leverage or 15, 20 times leverage. That's a lot of margin. You got to be pretty damn careful. Imagine if you're holding a bunch of stocks and you got all that margin debt. Your stocks are going down, so you're getting closer to that margin call as is, and you got your shorts that are working in your favor, but then your short position starts to work against you. So now you got your assets going down, your stocks, and then you got your shorts going against you. It's a recipe for disaster, and that's what happened in 08 and 09, and that's what would really cause things to, hit the fan this time around. And that's really what I've been looking for the last 6 months now, and it's finally starting to happen. So in the meantime, anything can happen with AMC, but yeah, it's good. What's going to be the biggest clapping of the week? Facebook, Disney, Amazon, bitch ass Microsoft. Um, you know, I don't think it would be Microsoft. I think if anything, it would be Amazon, Apple, or Facebook. Because, Amazon for their own reasons, right? They've already came out and said that they came out and said this like a month ago, that they cannot handle the inflationary pressures that they are seeing right now. Now, who knows what that means if they're going to up prices more? They already did that 5% increase gas like surcharge or whatever it was. They've been raising prices on merchants and stuff like that. But that's what I would expect. Microsoft is more recurring revenue. So like I've heard a lot of people saying that like people who use their cloud service Azure could not go without it. So even if they raise prices 100%, if they doubled prices, these businesses would still need it. So I'm not as bearish on Microsoft, but anything can happen. But Amazon, Facebook, and Apple, those are the ones I'm pretty concerned about. Let's go ahead and take a look at what the earnings multiples are for Amazon, because that's going to be the key. Like something like Tesla, they can hold up a 200 price to earnings ratio or whatever it is. It's like crazy high. 205 price to earnings ratio. That's ridiculous. For comparison, Facebook has a 13 PE ratio. So for every dollar you're putting in Tesla, it's like 15 to 20 times more expensive than something like Facebook. Well, what is the difference? Well, Tesla sets a high bar, 50%, 60% growth per year, and they actually come through with it. They're setting high expectations and delivering on those expectations. That's the main thing. If we look at Google's PE, that's at 21. So it's not like high, it's not low. It's reasonable considering Google's 15% growth rate target for the next 5 years. It's not terrible, but still could come down if they start to butcher that growth target. And then look at Amazon. They got a 44.55 PE ratio. So Amazon, Apple, they have very high PE ratios. And Amazon is really based off of AWS. People are, that's their main growth machine right now. If that does not impress investors, Amazon's getting clapped. That valuation could easily slash in half. That would roughly that would hurt the stock. And then Apple, yeah, there's a rumor of a share buyback for Apple announced at earnings. Yes, and it's funny because in a normal market, if earnings were a little bit bad, people would say, yeah, sure, earnings were not as what we expected, but they're doing this buyback. That's not going to basically cancel out. That's if Apple earnings are bad, then a bigger share buyback program is not going to save them, because what the issue is growth. If investors are like, hey, if the company's going to decrease growth by, let's say they have 10%, 15% less revenue, but they increase their share buybacks, it's like, we don't want to pay for that right now, right? So the growth is going to be very important. But yes, I have also heard that. I believe Citibank came out with that. I believe. Quote me if I'm wrong, but I believe Citibank came out with that. Is it Sunday night already? What is up, TCI? What is going on, Vlog? Yes, it is Sunday. Tomorrow is Monday. It's time. Oh, Edward Morgan, thoughts on ATER? I got some plays. They are clapped. It did hold up good level, and it does have a really high short interest, like still last time I checked. We'll look in a second, but it is holding up this range, right? Let's go ahead and mark it on the daily. It's holding up right this range in here around $4.39 per share, give or take. Bounce off of that a little bit. we're still above the 50 and the 100-day moving average, and you do have a trend line going on, right? Like it's obviously not as bullish as it was, but you still have an overall, call it a bullish stock chart. Like it hasn't fully deteriorated. So it's one of those things where I think it's going to be pretty hard to go to like 10 or 15 without some level of catalyst, or the market's taking a breather, whether Apple earnings are good, or maybe Tuesday, Microsoft and Google earnings could save the day. Those are really the companies, if I were to choose right now where to put my money, it would probably be Google and Microsoft. Out of any of these companies, well, PayPal too, but Facebook, don't want that. Amazon, don't want that. Apple, don't want that. So that could ultimately save the day in the beginning parts of the week. But, the growth, that's it. That's all it comes down to is, are these companies growing? If they're not growing, then you're not going to value them as high. And specifically with Apple, I hate to be like the only guy in the world that hates on Apple here, but there's a specific reason, right? Like Apple was a stagnated business up until funny money started flying around, right? In 2018, Apple did $265 billion in revenue, $59.5 billion in earnings, bottom line profits. That's what this blue is. That's what earnings are. In 2019, they lost $4 billion comparatively to 2018. And their revenue went down $5 billion. 2020, they increased revenue by about $14 billion. Earnings went up about $2 billion. So it was very stagnated. Like this is like 5% growth per year. Not even. Like if you average it out, it might be less than 5% in these 3 years, 2018, 2019, 2020, and then 2021 set the bar super high. Revenue $365.82 billion, earnings of $94.98 billion. Like if you cannot beat that in 2022, you're gonna take a massive beating. And that's really like the simplest way to put it. It was a stagnating business. It got a lot of funny money, a lot of pent-up demand. Maybe Apple sees comparative revenue numbers to 2019, 2020, or maybe it's less than that. Imagine if the revenue somehow is less than 2020. Like that would not, like a share buyback program is not going to save the stock. If let's say, what's the expected? That's going to be very important. Oh my God, yeah. That's a tough one. Estimate for Q1 full year 2022. Revenue of $118.7 billion. That's a tough bar. What, you extrapolate that out. Yeah, that's a really high bar. That's a really, really high bar. That would be like $474 billion of revenue for the full year. That's a lot. Like, they usually don't even come close to that. Or is that for, no, maybe, hold on. Is this actually, is there shit 1 month, 1 quarter behind? Oh, Q2. Yeah, they have their full year weird. So Apple's full year actually starts like where Q3 would be, or ends where Q3 would be. Okay. Okay. Wall Street is expecting Apple to report revenues around $94 billion and earnings per share of $1.43. That's an uptick from expectations for the March quarter in January, which hovered around $90.3 billion. So they've actually increased their estimates of almost $4 billion since last earnings. So they've actually analysts have revised their estimates to the upside. Apple crushed earnings expectations, but warns chip shortages could hurt revenue. But they still revised up. Have a revenue impact of $3 to $4 billion in the June quarter. Oh, that's 2021. Yeah, so it's a pretty tough bar, and that was posted 4 days ago. 94 billion, yeah. Oh. Are you in the basement? I am not Joe Biden, Super Show. I'm just playing. No, I've been in my basement like twice, to be honest. Facebook puts. Yeah, Facebook is interesting. Puts in Netflix going down because of the new series he's expecting, where a guy is expecting a baby, what? Is that true? Oh my gosh. That would make sense, actually. I think you're onto something, Simon. Like that makes a whole lot of sense. They would just look at it. If they got killed, they would just buy the dip. Amazon get hammered the week of their last earnings with that fake shit and got the lame ass jump from AWS. Yeah. Amazon earnings last quarter were not that good, but AWS was good. That was really what saved their earnings. But I don't know if like earnings can be saved this time around, because think about it. Tesla, right? What did Tesla actually do? Like what they closed down or up? I think they were still up on the day. No, Tesla. Yeah, like you can't even hold. I mean, like you're up a little bit from where it was, 976, but you've sold off all of that. And if any stock was going to rally, it was going to be Tesla. Like, there's no other way to put it. Tesla, like the raw materials were a lot more expensive, but granted, they do have different contracts. But expectations, were not like they were high. But if anyone was going to fail on earnings, it was probably going to be Tesla. Like they already missed their delivery expectations before earnings had came out. So I don't know. Like if just something is bad and growth is slowing down, you're going to get that growth fear. And then we do have GDP that comes out Thursday morning as well. That's going to be just massively important. You do have core PCE as well. It comes out Thursday, 8:30 in the morning, as well as Thursday, 8:30 in the morning. You have GDP quarter over quarter for Q1. With all the concerns about a recession, GDP is going to be very important, because if you guys don't know, I don't blame you. I didn't know this, until I started to get real deep into investing and all that. But a recession is technically 2 declining quarters of GDP growth, whether they are small or big. So GDP, that comes out 8:30 in the morning on Thursday. If that is bad, it's going to really just throw off Apple earnings. If GDP's bad, if Apple earnings don't come in at that $94 billion revenue expectation, oh man, not good. This is not going to be good. Oh yeah, what is ATER at? Man, this pollen clapped me. I need some Claritin. Yeah, ATER still, too, has a 42.41% short interest and like hundreds of percents for cost to borrow numbers. 100% utilization, days to cover at 1.11. And a lot of the flow is locked up, so I think it's a pretty good bet, but we'll see. With Ukraine being a major producer of wheat, rising fertilizer costs, and the expected forest fires that will tear across the Canadian prairies, how can we make some money before this shit kicks off? Well, there would be a couple ways. You just have to be a little bit careful because it could be priced into the market. So one way that I've been thinking about that, because I've been thinking about that as well, and like a lot of people are saying a food shortage. Let me just tell you, there is never a shortage of anything. The question is, do you have enough money to pay for it, right? So if there was a quote unquote food storage or shortage, there's enough food, but some people don't have enough money to pay for it. And yeah, Ukraine does produce like 20% of the world's wheat or something crazy like that, around those figures. If like wheat goes up dramatically even more, which it likely will as we get into the seasonality, not enough is likely to be harvested this year. One of the best ways to potentially play that would be the food stocks, like a Kellogg's or something that has to pay for their wheat and that cannot up prices as much on like food, like cereal makers, right? That'd be like a Kellogg's and there's a couple other stocks like that. That might be the way to play it, or just fertilizer companies in general. I would let them pull back a little bit and then I would get into it, because that's one of those where it's like there's no rush on getting some of those trades. They take a while. It's not like a earnings report type of thing, but I like where your head's at. I do. Gavin Grant. I don't hear baby hollering. Should we be concerned? She is with her mother. I don't know if she's watching the live stream or not, but yeah, she's with her mother. We get along sometimes, and then sometimes we don't. So, yeah. Started acting like a male character. Yeah, BBBY was wild. They had the buyout. Like a segment was getting bought out. Seeing on Wall Street Bets, I'm like, what the fuck? They went on YouTube to watch the trailer. Yeah, that's crazy. Netflix is, man, they're like savage though. Like some of the shows I know people have hated on before. But like, didn't they keep Dave Chappelle on there, or did they eventually take him off? I know they were getting a lot of like criticism for that at one point. Agree, Tyler. Markets are pricing in Fed rate hikes. Yeah, that's the thing. The markets really had not been like, they've been pricing in the Fed rate hikes. Like if you look on this, we've talked about it many times. Like they're firmly pricing in like 50 basis point rate hikes the whole year. But the Fed does not have a lot of credibility when it comes to raising rates. Like they started raising rates. We'll pull it up. We'll go ahead and pull it up. Yeah, so they've like they started raising rates, 2015 went very, very slow. They said they were going to go fast, and then they kind of stopped in this whole time period from July until November. And then they started raising rates more. And then when we got to 2.5%, they dramatically started to cut rates in July of 2019. And that's what actually caused the markets to really sell down in a very dramatic way, because believe it or not, when the Fed cuts rates, that is the time to panic. It's not when they raise rates. The time to panic is when the Fed cuts rates. Man, let me go back. What do I do? I don't want to be zoomed in anymore. Yeah, like when the Fed cuts rates, that's when you have a problem. Food shortages are real as fuck. No, they are. But not in the sense of what you'd think. There is always enough food in the world. But why do people go hungry? In Africa, it's because they don't have enough money to pay for it, right? If there was a billionaire in Africa, they are not going hungry. That's the thing. That's the biggest problem. Like, there's plenty of food. There's plenty of whatever we need. Like, there's plenty of oil. There's plenty of pretty much anything within reason, right, that we need. It's just, do you have money to pay for it? That's the question. Like, do you think America is gonna go hungry? No. Right? We have enough money to pay for those kind of things. Everything revolves around money when it comes down to it. Like, if you live in Africa, if you packed up and moved to Africa, South Africa, they're not starving in South Africa because they got money. They're a developed country. They'll be just fine. They don't produce enough food to sustain themselves, but they have enough money to buy it. That's the thing. When there is a quote unquote food shortage, right? People up prices. Inflation hits, prices go up, and then people that would normally have been able to afford food, they now can't. And that's where you get, like, actual food shortages. Who knows, though? I mean, we've never seen a food shortage in the way that we could. So I don't want to, like, speak like we could never see one, a real problem. But we've never really seen a full food shortage. With Ukraine, they're the breadbasket of the world. So if Russia does actually cut off the ports and they're not able to actually get that wheat out, then that's like 13% of the world's calories. In that case, we could see an actual food shortage, but we've never seen that yet. At least not in, like, recent history. Maybe, like, hundreds of years ago, but not, like, recent history. But I do I do feel what you're saying, though. I do. I need conditioner. I don't know where that came from, but that was kind of funny. Does Melvin Capital have to cover all their old shorts when they open their new hedge fund? Oh, they've already been liquidated. Yeah, they've already been clapped. Like, if you don't have enough money to service your margin call, the brokers come in and take their money back. That's how it works. Like that's where you get, like, a mini short squeeze. Let's call it that. Something that runs like AMC from $2 to $20 back in January. It was those guys that were super over leveraged, had way too much of a portfolio allocation to AMC. Like, even like a 3 to 5% portfolio allocation in a short position is massive. Like, 3 to 5% of your entire portfolio in that short position, that's wild. So if that short position went against you 10x, if you had 3% of your portfolio in there, I mean, you just lost 30% of your portfolio, right? So those hedge funds, there was kind of no saving them. Some guys like Melvin Capital, they got bailed out. Because during the time we were in 2021, you could not get a yield anywhere else. You could not get a yield. So think about this. Think about this logically. Like, don't get too deep with it. The treasury rates were at 1%, even less than 1% during the January rally. So why did Citadel bail out Melvin Capital and likely bailed out a lot of other small hedge funds? Because Citadel has the capabilities to go say, hey, bank, I'm going to need like a $3-5 billion loan. I'll get it back to you, no worries. Citadel, plenty big. The bank don't even question it, right? I'm sure they look at some things, but they don't question it for the most part. Citadel gets that loan for 2%. They go lend it to Melvin Capital for 10%. Whereas Citadel knows the whole time, if I lend them money, if I lend them however much it was, I can't remember, $5 billion for them to service their margin call, and they don't have to cover, we'll wait for the stock to come down. I might manipulate a couple buttons and push the stock down. Whatever. You could throw your twist in there. But at the end of the day, the stock came down. Melvin Capital was able to stay in business and not forcefully just get liquidated and blow up their whole portfolio. Citadel got paid back 10, 15, 20%. They don't do those things for free. So that's what happened. It's like arbitrage, right? In the stock market, stocks don't go up and stay up with a short squeeze. They go up and they come right back down. So it's basically arbitrage. Who would not do that for a free 10, 15%? I mean, I would definitely do that if I knew my money was guaranteed, right? So that's the way to look at it. Tim, yo, I'm late. Better late than never, my friend. Better late than never. SPY never should have been at. No. I've been calling it a bear market rally because that's exactly what it is. I mean, a bear market rally is just what we've seen. It can be super aggressive and people think things are fine again. But let me tell you this, and this will really help. I feel like a lot of people as time goes. No matter if it's this year or 10 years from now, the markets will never bottom until everything else bottoms. If you see all of the stocks you're invested in that are down, 80, 90, 95% from their highs in some cases, if those stocks are bottoming and Apple is up 10% in a year, we've not hit the bottom. That's a simple fact. You have to see fear and panic in all stocks. Everything needs to be hitting, not necessarily like all-time lows, like an Apple, it's not going to fall as much as something else that's fallen 90%, right? Apple is not going to do that, but you need to see at least everything come down to like bear market territory, like 20%, especially when you're facing this kind of market environment. Like you have to see everything come down. If there's places to hide your money, then you have not washed out all of the excess margin or the excess capital in the markets. That's what happened in COVID, right? Everything came down. That's what happened in 2019 when the markets dropped 25% very, very fast. 2015 when the flash crash happened. Everything came down. You didn't have tech stocks, your high multiple stocks dramatically come down, and then you have Amazon trading at stupid multiples, 45 PE ratios. Apple trading at 28 PE ratios. The average in the markets for like the S&P is like 16, 17, I believe, somewhere around there. So you need to see things coming down. And obviously, when stocks like Apple control 7% of the markets are not going to bottom until these stocks do. It could be this quarter, it could be next quarter. It will be sometime in 2022. You will find a bottom. The markets will likely hit all-time highs after that, and everything will come back up. Some things, to be honest with you guys, are never going to recover. If they were hypey, if they were not really a legitimate money-making business, or at least in the future will be, some things are not going to recover. And no, I'm not talking about AMC here. Obviously, they have a business. I'm talking about, what's the one that everybody liked? Biogenomics, shit like that, like editing DNA. That shit could take 10, 20 years before it ever comes back. Like, stuff like that, right? Might never come back. But, I think everything will catch a bid maybe at the end of this year, maybe 2023. When the Fed cuts rates, that's the time where you're going to see the next major low points. It happens every time. Like these gray lines, gray bars are recessions, and the Fed cuts rates before every recession. And that's the time to panic. Or sometimes like the 90s, they were a little bit late. to cut rates. They kind of held through for a while, but most of the time the Fed will cut rates right before a recession happens. So, if they start cutting rates in like mid 2023, not good. Not good. And you would think it would be the opposite. Like, you would think the Fed cutting rates would be great for the markets, which it makes capital cheaper, but it tells you, hey, we got a serious problem. We should start panicking. That's pretty much what it told you. Like, what day did the Fed cut rates? It was like February something. Was it February 23rd? And then that freaked out the markets. I believe it was February 23rd. And they did it on a Sunday, I believe. Support economy during the coronavirus pandemic. What was this? March 16th? Yeah, so if we look at the SPY, where was March 16th, 2020? Yeah, like, is this really the S&P? Oh my god, that's terrible. Yeah, the markets were down 11% that day. And then continue to fall, like, even more. But they cut rates back here a little bit. Like I said, 50 basis points. And it was on a Sunday, so it kind of freaked the markets out. Yeah, they had been cutting since like when the 2 and 10 year yield actually inverted for the first time. And that was in August of 2019. They started to cut rates in here. But when the Fed starts to cut rates, it's telling you that something is not quite right. Long story short. But it's good. It's good. We're a ways away from that. But could the market, like, what is holding up the markets right now? It's Apple. It's Google. It's Amazon. And why are they holding up comparatively to Facebook or Netflix? Well, they are supposed to have growth. If they do not have growth, it does not matter about like share buybacks, dividends, none of that. They will not be saved. But Facebook earnings will most likely not be good. Yeah. Order more seeds so I can grow more food when shit hits. Yeah, no, that's definitely a good idea, Super Show. Like, I would definitely not argue that at all. Even shit, building a bunker right now, I wouldn't call you crazy either. Like, yeah, dude, I feel you. I may or may not have got an estimate on a bunker. That's the day and age we live in. Gotta handle my pollen mishap first, but we're on it, bro. But yeah, Facebook earnings. Facebook is like, the problem with Facebook, and I want everybody to fully understand this as well. Facebook is trading very, very cheap. It's the cheapest large market cap stock, tech stock that you could buy. It's at a 13 PE ratio. So this is more in line. I believe it's below what the S&P is actually trading at right now. Like, Facebook is very cheap. The thing is, if they're not growing users, right, then this could be like a Yahoo or like a, what is it? Like the old, could be like MySpace 2.0, right? You're not always guaranteed to stay the top player. So when you start to see growth actually coming down, and then at the same time, Facebook's seeing growth coming down, like users are leaving Facebook and they're citing competition. And then at the same time, you have a new venture you're doing, and you're going to be spending like tens of billions of dollars potentially per year on this for the next 5 to 10 years before you will ever see any money back out of that. That hurts your bottom line when it comes down to it. Even though Facebook has like stupid margins, ridiculous. Um, it doesn't matter if you're going to be losing $10 billion of potential profits to the bottom line per year. Like, just imagine that, right? Facebook in 2021 had almost $40 billion of profits. They made almost $18 billion of revenue. That's a very good profit margin that they are saying. But now shave their earnings by $10 billion if they're spending it in the metaverse. Well, now the stocks only had $29 billion of revenue, or maybe it's going to be even more than that. We really don't know. So if that's the case, it could still be expensive. So it really depends about the metaverse and how much they're going to spend and if they're going to lose users. I'll tell you right now, I use Facebook the least that I have ever used it in my life. I get on there from time to time, occasionally, but like I never get on Facebook. ANC stock. Stock goes down when shorts cover. Market is upside down. Basically. Tech stock's about to have a massive sale. I mean, I think so. Yeah. AOL. That's what I was thinking of. But couldn't put the, couldn't put the name on it. 1 minute candle right before close. What was that? I did see that. What you have and why the markets move so crazy the last 10 minutes of trading is it's called market on close. So the last 10 minutes of trading, you will see a lot of volatility in the markets, like almost every single day. Like if you look at it on a 1 minute, you will see like the S&P just going back and forth, just doing some crazy shit, right? And that's because everybody, like all the orders, like the MOC, market on close, you can get the number coming in, a couple $100 million to the buy side, to the sell side, or it can be billions of dollars to the buy or the sell side. And those are the last orders that are going through before the day ends, and those go in at the 10-minute mark. So we're looking. So this was the 10-minute mark right here. This candle, right? So straight down, these candles were super small, super small, 0.07% down, 0.03% down, and then the 10-minute mark hits 0.12% down. The next minute, 0.18% down. Slight rally, right back down again. Very big candles and volatility. So you can get that, the market on close for other stocks as well that are just really big or really, really negative or really bullish, I should say that. So that's what I would imagine it is. Not 100% sure, though. Microsoft, Meta, Apple, Google, Amazon, all have earnings this week. What's your outlook on all these guys? Hits or misses, then what will impact the spot? The GDP, that's what's going to affect the... That could affect the markets obviously a lot this week. And then you do have Hong Kong's Hang Seng index briefly falls 3%. Oil slides nearly 3%. Jeez, that is no bueno. Oh my gosh. Yikes. That's not setting up for a pretty day tomorrow. But what was the actual question again? Yeah, GDP comes out 8:30 in the morning on Thursday. That's going to be important. Thursday and after hours, you have Apple, like you said, and that's going to be very important. Now, like, personally, what I think will do well is probably Microsoft and Google. Like, if I were to estimate and like put my money on two stocks that would likely do the best, it would be Microsoft and Google for their own reasons, right? Microsoft, it's a software trade, businesses use it and they need it. Like it's not like an iPhone you can choose to buy it or not, or like an Amazon service. Like you don't have to get things through Amazon, right? But there's a lot of individual reasons, right? Like like Google, obviously, cash machine, slightly lower valuations too. And then you got Apple and Amazon, higher valuations. And they've really experienced a lot of those supply chains. Like these are mostly software businesses, Microsoft and Google, so it's not as bad on that front. Apple, it's for a long time been seen as a hardware trade, and obviously that has not been very good with the price of just materials going up so much. Then Amazon has its own set of issues as well along the same lines. But yeah, if I were to imagine Microsoft, Google, probably going to do the best. Amazon, Apple, they're on the chopping block. Facebook is also on the chopping block, obviously. Part 2, that's going to be pretty interesting. But I'm pretty bearish on Apple and Amazon overall because Apple's growth rate is like unsustainable. They were a stagnating business. I cannot comprehend in my mind how Apple could beat their 2021 revenue number of $365 billion of revenue after being stagnant the prior 3 years without stimulus. Like, we're not going to see stimulus in 2022. Obviously not. You're going to see the opposite. The Fed is contracting liquidity. They're making it more expensive to go out and get a loan, right? So I don't see any way in the world that Apple can beat these numbers. Now, if that reflects off Q1 these earnings or not, who knows? I think they probably will. So, that's my take. Chip shortages issues for Apple and Microsoft. See, Microsoft, like the chip shortages, people are already expecting like PCs to not be so good, Xboxes to not be so good. But with Microsoft, the only thing people really care about is Azure. And I've heard other people say, like analysts say, that it doesn't even matter how much Microsoft raised prices, that they would still need it. So it's not really something that, like, once you're on it, you kind of need it, like cloud storage, computing, shit like that. So that's my thought. Like Xbox revenue is like 8%. Like Xbox and Xbox Live revenue is only like 8% of Microsoft revenue. So I don't think it would have as big of an impact, but I totally could be wrong. Like, there could be something that I'm not seeing, but I'm pretty bearish on Apple and Amazon. Now, Apple does have that advantage of they could try to offset bad revenue numbers, bad earnings numbers by their share buyback program, and that's likely what they're doing. The fact that they are going to do a massive buyback program is kind of a bearish sign right there, and I don't think investors will be super excited about that. After all, if you're not growing and you're going to lose revenue year over year, who gives a shit about a buyback? like sure, it's fine, but investors want growth when it comes down to it, especially if we head into like a recession. That's where a lot of our growth stocks could come back to life. The ones that have been beaten down, 70, 80, 90%, but are growing 35, 45, 55, 65% year over year. That could be good. But if Apple is growing negative year over year, nothing is going to be able to save that. And I'm not just making that up. That's what we're seeing for Facebook. That is what we are seeing for Netflix. So I don't think it'll be any different with Apple. Maybe not as hard. They might not fall as hard though, because they're obviously they do have some things they can do with a share buyback. They have a small dividend. Like Apple pays like a 0.25% dividend. So it's not substantial enough to offset that huge revenue miss they might see. Like Apple was a very stagnant business. 2018, 2019, 2020, it was not like a growth stock like you look at Apple now. So people think it's safety, but if they reverse back to these 2019, 2020 numbers, it's not going to be good. And like, long story short, to like bottom line that, like we said, Apple analysts are expecting $94 billion in revenue. So if their revenue comes in, let's just call it $80 billion or 75 billion, a share buyback program is not going to help that. That's going to be a massive miss, and the stock will come down appropriately. Now, if they only miss by a couple billion and they have the share buyback, it might not be as big of a deal. But I think people are going to really pay attention to their streaming services, their other subscription-based models. Investors will also want to know about the subscription model they talked about for iPhones, because they want to make their business more like recurring revenue, subscription-based, instead of just buying the phone one time and you're good. But I don't know. Nowadays, subscription is not looked at very highly. So we'll see. Screwed for growth without ARM deal. Yeah, NVIDIA is a real risk to the market too. Like NVIDIA falls in the same category as Apple. Believe it or not. Not because they do the same things. They don't do the same things. NVIDIA, AMD, these chip processors chip manufacturers that make these computer chips that mostly went for like PC gaming, right? The data center stuff, that's their biggest growing revenue segment right now for AMD and NVIDIA. But what has happened, why those companies are so big, is because multiple years of demand was pushed up ahead of time because people got free money. When I call it funny money, I mean child tax credits, I mean stimulus checks, I mean unemployment benefits. That money went to the largest companies. Now, if it comes out that this quarter, without that funny money, these companies would not be growing, or just in other words, it was artificial growth, and it could be a while before we break records that we set in 2021 for earnings and revenue. It's not gonna be very great. It's not gonna be very good. But it's tough. It's really, really tough, because even if these companies do report good, look at Tesla. It's probably not going to rally these stocks super, super hard. Now, Facebook is one that I think could rally very hard if they totally pivot. Like, if Facebook comes in with 5 million new users, they come in with, saying they're going to cancel the metaverse or pursue other opportunities and get rid of the metaverse, this stock could go up 25% because they are so cheap. People really don't want to see the company losing tens of billions of dollars per year for the next 5 to 10 years. And maybe the metaverse becomes something, right? So, it's very cheap. I personally might want to play Facebook both ways. I don't think they're going to give up on the metaverse, though. That's just a theory in my mind. If they did, it could be very bullish for the stock. But I ultimately don't think they will. I don't think they will give up the metaverse that they want to do. I don't see it happening, but if they don't, I mean, you could target some pretty low levels for Facebook. I mean, Netflix got chopped twice in a row, but Netflix was a lot higher valuation. But Facebook, I mean, it's at a critical level. It actually closed under the lows that we've seen after last earnings, which the lows were like 185.82. That was the low of last earnings. So this line right here. So we closed under that. That's not a good sign heading into earnings. But the way that I want to trade these is going in large and making positions free. That's what I have right now. I have 30 debit spreads on Facebook, put debit spreads. I have 70 put debit spreads on Apple. I don't want to hold all that into earnings. It does have a max gain of 60,000 if Facebook and Apple were to drop 25% a piece, but I don't want to gamble in $1,700 on that happening, right? But if I can keep 35 of those Apple put debit spreads, that's what I'm going to do. If they go up a lot heading into earnings, that's what I'll do, is sell out half, roughly, keep some for free, hold the free lottos, and that's all fine and dandy. I'm not going to get greedy with it. But right now, the last thing you want to do is put a lot of money into these earnings trades and then lose, because like Snapchat, they were pricing in a 20% move. The stock didn't move close to that. So if you bought puts or calls, you got clapped. But if you had bought them and then made them free and held your profits, then all you lost was profits. And then you can't be too mad about that, right? I think Facebook is going to tank. You about to get paid this week. That's what we're trying to do. And if you guys want to see the trades, if you did not watch the videos, here you go. Since you are joining me on this lovely pollinated afternoon, then here, you guys can see some of the trades that I have. So I have an Apple, June 17th, 150 to 145 put debit spread. The max gain on this, because I have 7, is $3,000 if Apple closes under 145 per share by June. I actually got these a while ago, and I was negative on them for a very long time. Very, very long time. Yeah, I got these in April. No. It was before that. Was it? No, I've had these for a long time. I feel like it's been a long time. I did buy 2 more. It was April 14th. Yeah, so I've had these, the 5, for a long time. I'm up like 10% on these. If I wanted to, I could sell out and make them free, but I might just hold these because they're closer to the money. But I do have 7 of those. Max gain of $3,000. I put $758 into them. If Apple falls a lot, I don't know. I might make them free. I might not. But then I do have these. Apple 125 to 120 put debit spreads. A lot less likely, but still. They're up about 40%, up $200. I could sell out and make these free. That's what I will do. I only spent $500 on them, though, but they're really low probability. Like, to get a 125 May 6th put in the money, that would be a break even. I guess it's not terrible. The stock would have to fall 25% to get the max gain on these. So this is kind of crazy. If Apple did fall that 25% with 70 of these, you would make about $34,000, and you would only risk about $500. So it's not bad. You know, it's not very likely that Apple falls 25% though. But that's the thing. That's where a lot of opportunity actually is, because like these put options, their break evens are not a lot. Like the break even is 3% or 4%. The at the money put, the at the money call is pretty much 4% as well. So it actually looks pretty attractive doing a strangle at the money too, but we'll see. But they are cheap because nobody expects Apple to drop that much. So if it does and you're the degenerate that holds those contracts, you can make a lot of money, but not financial advice. I might get clapped. I might get clapped. Who knows? But they could be good. 25%, I like that. Especially if the markets do come down in a substantial way. And imagine that. Imagine if Facebook gets clapped again. Imagine if Apple gets clapped and Amazon gets clapped. The markets are going to panic, and everything's going to just get destroyed. Like, forget it. You're going to hit those lows in no time. Then I do have these. See, Facebook is expected to drop more. So, like, my max gain on these would be if Facebook falls about 35%, closes under 120 by May 6th. But these have a max gain of 1,000 a piece, and I got 30 of them. You know. Yeah, it'd be a max gain of about 30,000 if Facebook fell at least 35%. But it does cost you like $1,000. So these are like, what, 50% more expensive than the apples for a 10% larger drop than Apple. So like people are not expecting it on Apple. So I think there could be a good opportunity there. But yeah, I look to cash out and make these free as well. I'm down like 13% on them. I'm down 150 bucks. Currently worth 1,000. So if if things are red on Monday, man, I'm gonna probably make them free. Maybe on Tuesday, but we'll see. Everything looks pretty red right now. Explain debit spreads, please. I will gladly explain a debit spread. Like, gladly. So, what it is, it's very simple. Very, very, very simple. You just want to be careful to take your time when you're doing them so you don't accidentally clap yourself. Because there's a debit spread and a credit spread. A credit spread, I guess I should probably show like what not to do first and then show what to do. So, do what you guys want to do when it comes down to it. But essentially a credit spread is you would buy a contract that's further out the money and then sell one that is closer to the money. You're going to collect money up front, $115. But look at your max loss. Your max wow, that's not too bad. That's not too bad actually. It's not too bad. That really wasn't a great example, but you can essentially lose more than you put in. So like with a like when you buy an option, you can only lose as much as you put into it. With a credit spread, you can lose more than you put into it. So if you're ever doing this and it says a credit spread, stay away from it. Don't do it. Especially when you go super far out the money. Like if you do sell, I sold the 155, I bought the 160. Now you can see. You could lose $400, $500 would be your max loss while you collect $100. You don't ever want to do a credit spread, especially when you start. But what a debit spread is you buy a contract, let's say the 160, and then you could sell the 155s. Because imagine this in your head, and it will come up a put debit spread. If the stock comes down, and let's say the stock goes to 150, both of these are in the money, but you own one that is higher. So essentially you have protection. The other way around with a credit spread, you only have protection given the spread, so you can lose money on that. Lose more money than you put into it. With a debit spread, you can't lose more than the 105 that you would pay for it, but it caps your max gain. So if Facebook theoretically did go to like $100, if you bought a 160, you'd make $6,000 on that contract that costs $400. If you have a debit spread, you can only make the difference between these. So in options, every dollar move in a stock, if you're in the money, is worth $100. So between 155 and 160, that is $5. Your max gain is $500. And then, minus whatever you pay for the debit spread. So, but it allows you to do this in different ways. Like you could do it closer to the money and have a higher probability of making money. Like you could buy a 180 and sell a 175. That would cost you $215, but your break even on that is only 8% or 9% to make that full 500. So to make like 100% profit, you need the stock to drop 9%. I don't really like to do that just because it's not worth it on a risk to reward. If I'm putting up $200, I want to be able to make over 100%. But there's that. And then like what I did is the same. I bought a 130, I sold a 120, but I did it 30 times. So I have $1,000 max gain between 130 and 120 because it's a $10 difference, and it allows you to play some of these strategies for cheaper, right? Instead of buying 30 contracts of the 130 puts, which are very unlikely to hit as is, that's going to cost you $2,500. So it's not economical to spend that much money for, just if Facebook drops that much. So it allows you to utilize a smaller amount of money and get into trades, but it does max your cap your max gain. So that's kind of the best way to describe it. But there's a lot of ways you can implement it. You can do it for puts, you can do it for calls, either way. Like these contracts, like a 130 put is so cheap for May 6th because nobody really expects it to Facebook to drop that low, and especially the spread is $30. It's a low probability trade, but if you get it right and they hit, you can get paid out massively. That's long story short. That's basically that. But and then to sell them out, if you wanted to sell it out, you could basically come to the option chain and do the opposite. So I bought the 130s, I could sell the 130s, buy the 120s, and then it'll come up the total credit, and then I could type in 30 and get my money, right? What I want to do is only need to sell 15 of these to get out. And typically what you see, and the reason why I went $1,000 spread is because typically heading into earnings, you're not really gonna find a debit spread like the day of earnings that you can get that kind of risk to reward on. Like most of the time you can't spend $30 to get $1,000 max gain. Usually it's at about 1,000%. So it's not that common that you get like a 3,000% max gain on a debit spread. So in my opinion, I think these will go up in value this week. Probably could go as high as $100 a piece, and then I would look to make them free around $60, $70, $80 if I can, but we'll see. Just depends what happens with the stock, I guess. Yeah, did that answer it? Maybe. It's a very good strategy, though. Futures, yeah, still clapped. You guys see this? Twitter is taking another look at Musk takeover bid. What about Theta? Well, yes. Like, you don't want to do those far out the money debit spreads, and not financial advice, but you don't want to do those far out the money debit spreads unless there is a catalyst. Like Facebook has earnings on Wednesday, and typically, like last week, people were thinking about earnings, but they were not actually positioning for earnings, like for the most part. Now, what you'll see on Monday, Tuesday, and Wednesday, the implied volatility will likely go up. People will start to make their bets, and people will start to buy these contracts, and they will run the prices up heading into earnings. And then you will see like the prices after earnings. If Facebook were to go up, these contracts would instantly go to like zero. Right? You would lose all your money if you held them through earnings. So that's why I like to make, the money free. And this is only a pre-earnings run-up trade. This is capturing the volatility, the expected move heading into earnings, selling out before earnings happen, at least half, hopefully half. If I could only get 5 or 10 out of them, that's what I would do. Get those free and then ride it out. It's not something you want to do just on a regular basis. Like, you don't want to go 35% out the money on a next week contract with a debit spread, or just in general, unless there was a reason to. And Facebook earnings is the reason to. Like even with Tesla puts, like Tesla went crazy the day before earnings. Yes, the stock was down like 4%, but the contracts, the $800 next week puts, which is now this week, for Tesla, I bought those in the morning for $128 a piece. They closed the day at $695. Like, people start to go crazy around earnings and really run up the prices of the contracts. But yeah, I don't pay attention to theta. Really, in general, I don't pay attention to that. I've been trading options so long, like, I know what will hold value and what will depreciate in value, like fast or slow. And like a good rule of thumb when it comes to theta, anything that is really 3 to 6 months away will start to get beaten up by theta, especially less than 3 months. You'll start to lose just because of theta. But if you're buying like leap options, the theta has like no effect on them. Like, if you're buying the 2024 options right now, theta has like very, very little effect on the price of those options. Theta really kicks in 90 days until expiration, for the most part, unless you're super far out the money. Yeah, but I've been trading options for a while, so I know how to value the contracts. Like, I know these contracts are dog shit. Like these contracts are absolute dog shit. That's what makes them so attractive on a risk to reward basis. Like, the odds of Facebook dropping 35%, normally, not so likely. This time, they're a little bit more likely, because it kind of happened last time around, but they're still dog shit. Like, bottom line, like, if Facebook doesn't move, they're still going to go to zero. That's why you have to get your money back before you head into earnings. Don't listen to anything I say. Buy any of these trades and then not make your money back. I don't care if you have to, like, personally, if I had to sell at a loss, if for whatever reason Facebook rallied into earnings, that's what I would do. I might hold 5 of these. You know, I might put 150 on it, right? If for whatever reason Facebook rallied and I was wrong and the IV didn't hit these contracts and they didn't go up, I would have to take the L and, sell out like 25 of them and hold 5, because I don't want to hold 30 of these heading into earnings. I want to hold 15. I want a $15,000 max profit, maybe 20 if I can. If I can, I'm not going to get greedy with it, though. I know these are dog shit. So are the apples. But in this market environment, dog shit can make you a lot of money. I mean, that's something we have seen for sure. Movie theater owners are optimistic about ticket sales before key summer season approaches. Blockbuster titles like The Batman, Sonic 2, and Spider-Man No Way Home have led to a 365% increase in ticket sales from 2021, reaching $1.85 billion. Movie theater owners tell CNBC they are hopeful that ticket sales will continue to pick up in the coming weeks. CinemaCon, a convention for Hollywood studios and movie theater owners in Las Vegas, kicks off Monday, and exhibitors are expressing cautious optimism ahead of this summer movie season. I feel you, bro. I feel you. We want the theaters to do well. Why does that guy look so familiar? Why does that guy look so familiar, bro? Puts on DWAC. I feel, man. I feel. The Batman was good. I have not seen it. Oh, I thought that guy looked like somebody else. You guys ever seen the Dumb Money guys on YouTube? I thought that was the one bald guy for a minute. Kind of looked like him from the side. But yeah, futures pretty clapped, down 0.62%. Nasdaq down 0.63%. S&P down 0.61% on the Dow. Oil is down almost 3%. Asia clapped as well. That's not a good sign heading into tomorrow. Down about 2.65% on the Shanghai Composite. HSI 2.61, Nikkei down 1.94, ASX 200 down 1.57, Kospi down 1.57. Yeah, it's not so good over in Asia. So yeah, I don't know. I'm gonna get off here though. Thank you guys for tuning in, letting me rant to you guys. Hopefully we make some money this week. Let me know in the comments of the last video what you guys are trading. Throw out specific trades if you guys want to. I always like to take a look at those. Like Super Show, he got me in Mullen, man. I still own Mullen. It's gotten beat down, but I still own it. But yeah, so thank you guys for tuning in. Appreciate all of you guys.